At the end of the day, a company dies if it runs out of cash, which, as I noted, can happen if it is either not profitable or cannot raise capital to continue operating. Add to that the 2008 subprime mortgage crisis and the dot-com crisis of 2000, and you end up with a very simple realization. Crises make fundraising harder, and for a very good reason. Uncertainty drives investors away. Their appetite for risk decreases, and the result is that their willingness to invest is much lower. Therefore, the number of deals decreases. Getting funded becomes harder, and companies have to be more attractive than usual to investors. Let me demonstrate this concept with the 2022 bearish market. It started in 2021 and ended with an all-time high in the S&P 500 index. Within a year, the market went up by about 30%. People got richer, and their risk appetite became higher. At the same time, the interest rate was close to zero, which meant there were no real alternatives in which to invest money. Then 2022 started with a combination of events: the war in Ukraine, the supply chain crisis, and inflation, all of which led to increasing interest rates and a bearish market. As a side note, 2021 was also a year of money for nothing, which drove inflation. There were two main sources of this money for nothing. The government poured money into the public during the height of the COVID-19 pandemic, and the S&P's dramatic rise drove spending up. Demand increased, prices went up, and we all got the result: inflation. The mindset of an individual investor can shift very quickly, from an appetite for risk to being more conservative. The bearish market of those years eliminated a good chunk of the profit that many investors planned to invest in startups. The interest rate got to a level that they could get 6% risk-free. All those reasons changed the thinking of most investors, and rather than looking for high-risk, high-return investments, they sought out more solid, safe alternatives. The impact on the market was even more dramatic. Having the S&P down meant no IPOs were on the horizon, so companies that planned on going public had to wait, perhaps 2 to 3 years. In this situation, the only remaining alternative for those almost ready-to-go public companies was getting further investments from existing investors. The implication of these changes was fewer resources for investment allocation in earlier-stage startups and less money for new investments. This ripple effect made the earlier-stage companies even less attractive than companies that had already demonstrated some traction or that had figured out their product-market fit, PMF. But no matter the reason, all valuations ended up way lower.